A crash in the housing market is almost inevitable, and in this video I'm going to explain why. But before I get too far into it, don't forget to smash the like button for the YouTube algorithm, subscribe to the channel, ring that notification bell, and let's get into it. Over the last couple of years, the housing market has been on an absolute tear, and this has been driven by a variety of different factors, inclusive of a sustained period of relatively low interest rates, a limited supply of inventory when it comes to a lot of these homes, and the demand for homes being absolutely ridiculous. And the demand for homes is not only as it relates to the individual home buyer, but also institutional investors that have been buying a large amount of properties and effectively jacking up home prices. But a lot of these things continue to persist. There continues to be supply chain related issues, particularly from the Far East, where there continues to be issues associated with the pandemic, due to which the supply-demand imbalance continues to persist. So what's changing? Something has got to change that would effectively result in a crash in the housing market. And while there are several reasons for it, the biggest culprit for this just so happens to be rising interest rates. And let me explain that just via an example a little bit further. When I refinanced my home back in early 2020, I got a 30-year mortgage rate of 2.375%. At this stage, the 30-year mortgage is well over 5%. Just to make the math a little bit simpler, if you had a 2.5% interest rate relative to a 5% interest rate on a $300,000 home, your monthly mortgage payment differential would be $500 a month, and over the course of a year it would be $6,000 over 12 months, and that is very real money when it comes to a lot of people. That should in itself create a headwind when it comes to the housing market in general. And it's not just that. Analysts are forecasting, as well as the Fed has made outright commentary, that there could be 10 plus increases in the Fed funds rate between 2022 as well as 2023. So you can imagine what's going to happen with mortgage rates during that period of time. Now, understandably, I know there's not a direct linkage between mortgage rates as well as the Fed funds rate, but the Fed funds rate does impact the prime rate, and the prime rate does impact the mortgage rates as well. So some analysts are basically expecting that these interest rates on the 30-year fixed, as an example, will cross 6%, and that may not be the top of it, and it will continue to increase even thereafter. The Fed has made it abundantly clear that they're going to do whatever it takes to basically solve for inflation. Inflation at the last CPI print was over 7%, and there are some indicators that would suggest on the next CPI print we could be looking at 8 or over 8 and potentially even 9% when it comes to the CPI print, which is a measure for inflation. These rate rises are going to have a very significant impact when it comes to the housing market. When it comes to rising prices, it's impacting the global economy as a whole. And one of those components is associated with raw materials, and those raw materials directly impact the prices of homes. The prices of raw materials for home builders continues to go up. Home builders are in the business of making money, due to which they're going to prop up the prices of a lot of these homes as long as the prices of raw materials continues to increase. And with supply chain shortages continuing to exist and continuing to permeate across the global economy, suffice it to say that these prices of raw materials is basically going to continue to increase, thus driving up prices for homes. So now if you're an individual home buyer, you not only have to deal with the high valuation when it comes to the home, you also have to deal with these rising interest rates. And you can forget about this whole notion about a cash only offer, because it is true that some people who do have existing homes, they borrow against those existing homes in order to buy a new home. But with that said, even those borrowing rates on the existing homes, whether it's through a home equity line of credit or a home equity loan or whatever it might be, those rates are also going to continue to increase. This whole thing isn't just going to impact the prices of new or existing homes. This is going to impact the housing sector in general. Over the last couple of years, as people have been spending a lot of time in their homes, they have been borrowing against the equity on those homes as those home values have continued to increase in order to make investments within those homes. homes. And this has effectively propped up the stock prices of a lot of companies that help out in this particular domain. Take, for example, the stock prices of home improvement companies such as Home Depot and Lowe's. These companies have been absolutely rewarded as people have been spending more time within their homes. Therefore, the entire ecosystem when it comes to the housing market is going to get impacted. This is inclusive of new home companies, new home builders, existing home type of mortgage lenders as an example. This will permeate to furniture type of companies, and as I mentioned, home improvement stores as well. So with all of that said, right, with rising Fed funds rate, when you've got rising inflation, you've got supply chain related issues, you've got all of these issues kind of like coming together at the same point in time, the path to a crash in the housing market is pretty straightforward and is very easy to see. The silver lining out of all of this, of course, is for new home buyers, right? So people that are effectively looking to buy a home. Now, assuming these folks can, of course, combat this notion of rising interest rates, once the prices of homes starts coming down or at least leveling out some, then these people can potentially have the opportunity to get into some of these homes. And when it comes to a lot of these institutional investors, they are also looking for some rate of return. But when the rate of return effectively starts compressing quite a bit, then there's going to be more opportunities for individual home buyers as well. And that arguably is the silver lining in this whole process. So now it's up to you. Do you think we're headed towards a housing crash? Do you think we're headed into a broad-based recession in general? Include all of those thoughts in the comments. If you've made it this far to this video, don't forget to like and subscribe, and I'll see you in the next one.